When you look at a company's financial statement, what do you see? Be honest. It's just a wall of numbers, right? It's easy for your eyes to just glaze over. But what if I told you it's less like a boring document and more like a crime scene? Seriously, every number is a clue, a fingerprint, a piece of DNA that tells you exactly who a company is and what they're trying to do. Today, we're going to be financial detectives. And our first case, it's a big one.
So here's the challenge for you today. Our main suspect is one of the biggest companies on the planet, Amazon. We're going to look at a bunch of anonymous financial data and see if we can pick out the online giant from a lineup of other pretty famous companies. You think you can do it? Let's find out. All right, here's our lineup. We've got a dozen companies from totally different worlds. Everything from an airline to a bank, a software giant to a grocery store. We've taken their financial statements and completely scrubbed the names. Our job is to match the financial profile to the right company. Now, you can't solve a case without the right tools. But don't worry, you don't need a PhD in finance for this, not at all. We just need to understand two key clues, two numbers that tell us a ton about how a business really works. First up, accounts receivable. This sounds complicated, but it's not. It's basically a pile of IOUs from a company's customers. You know, when a business sells something but doesn't get paid in cash right away, that debt goes into accounts receivable. So the real question, the clue for us is, how long does a company have to wait for those IOUs to get paid? And this is where we find our first huge clue. Think about it. A retailer, like a grocery store, gets paid almost instantly. You go in, use your card or cash, and boom, they have their money. So their day's collection period is super, super short. But a company that sells to other businesses, they might give their customers 30, 60, even 90 days to pay up. That one number is a massive clue about who their customer is. Okay, the second tool in our detective kit is inventory. This is all the stuff a company has sitting around that's planning to sell. Now, for a business, you've got to think of inventory as just cash that's tied up. It's sitting on a shelf instead of sitting in a bank account. It's also a big risk, right? What if that stuff spoils or goes out of style before you can sell it? In man, does inventory tell a story? A software company's product is just digital code, so their inventory is practically zero. But a grocery store, they need a massive amount of physical stuff on the shelves, and they're always worried about it going bad. Okay, we have our tools. Let's start the investigation. All right, toolkit in hand. It's time to crack this case. And we're going to start with the most obvious clue there is. We're going to follow the cash. So first step in any investigation, let's group our suspects. Which of these companies sell directly to people like you and me? Let's figure out who the retailers are.
Okay, so take a look at this data. You can see a huge difference, right? Some of these companies are waiting 60, even 75 days to get paid. Those are probably our business-to-business companies. But then you've got this other group. Look at companies H and I. They get paid in just 4 or 5 days, and A, B, and K are not far behind. These have to be our retailers, because their customers are paying with cash or credit right there at the counter.
And boom, just like that, we've cracked the first part of the case. Based on that one single clue, we've found our group of retailers. It's got to be Amazon, Barnes & Noble, Kroger, Walgreens, and Yum brands. They all sell stuff directly to us. Okay, so we've narrowed down the field. We've got our retailers in a group. But now for the big one. Among these companies, which one is Amazon? What makes an online retail giant look different financially from a physical grocery store or a pharmacy?
Let's pull out 2 more clues. First, something called property, plant, and equipment, or PP&E. This is basically a measure of their physical stuff, buildings, stores, warehouses. Second, accounts payable. That's the money a company owes to its suppliers. Just look how different these 3 retailers are. And this is the smoking gun. Company A has the lowest investment in all that physical stuff. Well, that makes sense for an online retailer compared to a huge grocery chain like Company I, which must be Kroger. But the real giveaway, the killer clue, is accounts payable. Company A owes a massive amount of money to its suppliers. Now, this isn't a sign of weakness. It's a sign of pure, raw power. Amazon is so huge, it can basically tell its suppliers, "We'll pay you when we're ready." Case closed. Company A is Amazon. Okay, we found our main target, but a good detective never leaves loose ends. Let's use that same logic and quickly unmask the rest of the lineup. Let's follow the last few breadcrumbs. Who has a ton of physical assets, like huge PP&E? Well, that's got to be a utility company like Duke Energy. They have power plants everywhere. Check. Who has almost zero inventory? That's the classic signature of Dell's build-to-order computer model.
Check. And finally, which companies have a lot of other assets, stuff you can't touch, like patents and brand value? Well, that just screams pharmaceutical and software giants like Pfizer and Microsoft. Check and check.
All right, the investigation is complete. All the clues are in. It is time for the big reveal. And there you have it, the complete solution. Every single company, from Amazon to Citigroup, has a distinct financial fingerprint that points right back to its real-world business model. Pretty cool, right? But what's the real point of all this? Look, this game is a lot of fun, but it's not just a game. It actually reveals the secret formula that every financial analyst uses to figure out how a company actually makes money for its owners. It's called the DuPont Framework, and it boils everything down to 3 basic levers a company can pull. First, profitability. Are you making a lot of profit on each thing you sell? Second, productivity. Are you selling a massive volume of stuff? And third, leverage. How much are you using debt to boost your results? And here's the really important part. There is no single right way to be successful. A company like Pfizer makes a huge profit on every single pill. That's high profitability. Meanwhile, a company like Kroger makes a tiny profit on a can of soup, but they sell billions of them. That's high productivity. They're pulling totally different levers, but both strategies can create a great return for their investors. You know, this whole thing gets to the heart of what finance is really about. It's not just about the numbers. The numbers are dry. It's about understanding the story behind them, the company's strategy, its strengths, its weaknesses. The numbers are just the language that the story is written in. So now you have the basic toolkit. You're a financial detective. You know how to look past the raw numbers and see the strategy underneath. So I'll leave you with this question. If you looked at the financial clues for your own company, or maybe one you're just interested in, what story would they tell?